A very warm welcome to all our viewers and especially Prabhanjan, who has just flown in from Qatar back to Dubai. How was your journey, Prabhanjan?
No, as far as the climate is concerned, it's the same. So there's nothing to complain. It's the same from another 45 degrees to another 50 or 45 degrees. But yes, it's a business travel. It was good. So a bright and cheerful good morning from Dubai to all stock market enthusiasts and to you, Ashwin.
Wonderful, wonderful. So, just to a very quick update to all our viewers. So, Lakshmi is on travel, so we are missing him. So, I'm donning the role of the host as well as the analyst, a host from Talk of Town Studios and analyst from DA Capital. Uh, we saw the markets just like the weather, which in Bangalore, which kind of gave us the hope of a bright week ahead. Markets too did start off kickstart with a very good positive note. As we were inching to almost that 2% mark, the markets yesterday suddenly gave up and we closed well below 1% for the week. I'm predominantly talking about Nifty and Sensex. So all that started off well did not really end well. But overall, we have closed positive for the week. That's a good thing. And amidst the news of recessions or the biggest bubbles, probably not in this year, being rescheduled to 2026, and amidst the major domestic news of GST 2.0, which Prabhanjan is closely following and updating all our viewers. I would say that's pretty much a long term view for us right now. Getting into the more close weekly outlook, we will talk about how the macros and micros are looking, both from the domestic factor as well as the international markets, and help our viewers take better judgment calls on the markets for the week ahead. So, over to you, Prabhanjan. First, we will talk about the international markets and then we will move to the domestic markets.
Right. Thanks, Ashwin. So the crude, if we talk about the crude, it's around 67, and it's a bit because of the geopolitical tensions. And you said though, there has been peace talks that was going on, but still Russia is impounding on Ukraine. So this has made the crude inch towards 67 levels from 65.
Mm.
Dollar index is pretty stable, but you see the rupee. It's again. I don't say it is stable, but it is hovering around 87.5 levels. It's been there for the past 3 weeks, and year to date in 2025, rupee is the worst performing major asset, major Asian currency, down about almost 2.8% against the US dollar. Talk about Indian VIX, it's around this 11.7. CBOE index is about 14.22. Interestingly, this fell from 20 levels to 16 levels to 14 levels. Bitcoin 115 hovering around the same levels. So now a lot of to talk about the major US macro factors. Uh, what started off as a shaky few days, the tech heavy indices like the Nasdaq and S&P was trading a little lower, flipped sharply on Friday um, after the Fed chairman Powell spoke about Jackson's Hole. He opened the door to potential rate cut as soon as the September, citing emerging risks in the labor market. This triggered a powerful rally, but I would rather call it as a short covering rally. The Dow surged about 1.9%. S&P was about 1.5 to 1.6%. Nasdaq gained close to 1.9%, so on and so forth. So it was the powerful dovish pivot that registered a global liquidity flows, I would call it. Um, on the macro global spotlights, we all know that there has been a Trump-Putin Alaska summit. Um, there has been no substance, but no deal, and Trump always reiterated, no business until peace prevails in Ukraine. The more tangible outcome is temporary easing. He said no immediate move against India or China for taking Russian crude. But however, we have seen in the during the weekends that 25% tariffs are imminent, and they have imposed again 25% tariffs. So 50% tariffs on India, markets more or less, they have observed. So they have already digested this news. So on what it means for the Indian markets, is volatility will stay on the table, especially on the IT and metals, thanks to the global earnings, mood swings, and tariffs uncertainty. Um, the rupee may stay gently under pressure, and strong dollar settlement and sticky yield differentials. These days the yield differentials have the scope has widened a bit.
Yeah, yeah.
So the RBI must manage liquidity very, very smartly. Crude remains the joker in the deck. Lower prices help inflation, but any US clampdown on Russian imports could always reverse that trend. Uh,
Hmm.
Strategic sectors stand out: defense, semis, renewables. Particularly Micron's Gujarat semiconductor lines and green energy firms. They look structurally poised amidst supply chain realignments. So there should be a balanced basket strategy, combined defensives like IT and pharma, with momentum plays like infrastructure and PSU banks. That would be the play or the direction in the coming weeks.
In fact, I was about to ask you that look, we understand that mutual funds have the bandwidth or the need to have a large portfolio size. When I say large portfolio size, I'm talking in terms of number of stocks that they hold. But
Right.
even portfolio management companies who are known to have concentrated stock baskets are now almost doubling down on the number of stocks that they are holding.
That's
One
true.
of the key factors or key reasons they have quoted is that which we have been telling our viewers for a very very long time now is the next set of rally, the evident rally that is going to happen. uh, let's not try and time it when it's going to happen or whether it's going to start in Diwali or Jan of next year, but whenever that happens, it's not going to be a broad market rally. It's going to be a rally which is fueled by a couple of sectors or cyclical in nature. Now,
Absolutely.
keeping that in mind, it is quite understandable why these portfolio management companies have doubled down on the number of stocks that they have. Now, if an investor is, let's say, either sitting on 100% cash, I know not many people are doing that, maybe 30-40% cash with the intention to actually invest for the long term, what kind of sectors that you would personally be looking at? I understand we are not trying to give any stock tips or advice here. We are 100% in alignment with the regulator of not giving any stock advice over here. But just from a sector point of view, let's not go to the stock specific topic here. But from a sector point of view, what is that you would be looking at, and where would you be placing your bets, Prabhanjan?
Well, Ashwin, we need to look at this from 2 point perspective. One is the global factors, and one is the Indian factors.
Right?
Uh, if you see now, the global markets, including the European markets, are taking all-time highs. But if you see the Indian markets, they are actually underperforming. So currently in India, it is more of a local play than a global play, right? So I have been hearing a lot of analysts saying that if when the markets are rising, the Indian markets are not rising at all. But what if the global markets start cracking? Where will we be? So I would always say now the Indian markets, of course, cannot be insulated. It has to follow
Or
the same.
cannot operate independent of the global market?
Of course. But yes, the weightage of the local factors will weigh more than the global factors, because more or less the global factors has sorted out except these tariff issues. But the local factors is where we have to have a lot of weightage while designing our portfolio. So to
Hmm.
answer your
Hmm.
question, I always have been a great fan of secular growth sectors. The reason why secular growth sectors, I always say, is sooner or later, those are the sectors will always tend to play out. And recently, the GST revolution, or whatever, Prime Minister Modi has been talking about, we also need to take into consideration those aspects, because a lot of cash flows, a lot of you know the demand buoyancy is going to improve. maybe one thing that I want all the stock market enthusiasts to understand from the local perspective is that, maybe by reducing the GST rates or by standardizing bringing uniformity in the rates, maybe we can have a hit for 1 year. But everyone has to understand here the buoyancy it is going to build over a period of years. The compounding effect it happens over this buoyancy is going to be very, very, good. So having those things into consideration, I would always place my bet on the consumer and FMCG, auto and two wheelers. Whatever we might say, the auto EV related ancillary stocks, or any ancillary auto related stocks for the two wheelers or the other, is always stands to gain, because the market share in India is, we have not even captured 20-25% of the global markets. So this is one sector where we need to look into. And another sector which we also need to get into is the real estate sector. Time immemorial, I was never been a great fan of real estate because of the corporate governance issues and all that. But however, the recent the talks on tax cuts on the cement, appliances and building materials could nudge down some of the construction costs. So we this is also a time to get into some of the real estate stocks. So the consumer and FMCG, auto and two wheelers, of course the ancillaries, real estate and construction would be one of the sector where we can diversify. And not to forget, there are two more sectors. One is banks and NBFCs. I mean, this is one of the top notch in a secular growth. So this is one thing where we have to concentrate, particularly as NBFCs who are into the house, the first time house buyers, or who wants to get into this housing, who always which always supports this housing sector, is one thing which we cannot we can't leave our eye on it. Last but not the least, the insurance and healthcare sectors. Expectations of lower GST on health and life insurance, possibly down to 5% or maybe zero. I mean, I'm just asking a huge ask, but it could definitely benefit both insurance and policyholders. So these are the five sectors where I think largely you should concentrate and bet on your portfolios. And I'm sure, see, stock market is something where I don't always recommend or suggest that you should make umpty gains, you should make rhetoric gains. No, you should always make a compound decent returns of
Correct.
that is going
I
to
mean, you're
definitely.
growing with the business. The rate at which the business grows is the rate at the which you make money. As simple as that.
Absolutely, absolutely. I mean, there are only some years like COVID years where you make windfall gains, and our target should never be windfall gains. It
I
should
mean, let's not forget to make that windfall gains. We would have had to go through the pain of for those 3 months before that.
exactly. So the mantra of arriving at your rate of return is very simple. To put it into perspective, mathematical equation, you should always have the risk-free rate of return in India plus your GDP rate plus your alpha, whatever you wanted to ask, put it for playing in the stock market field. That should not be more than 15-16%. If you're making it, and I'm not saying that 15-16% you'll make it every year. You might not make it for 1 year or 2 years, but you will get it compounded in the third year.
Absolutely, absolutely.
Yeah, you should have that patience. You should always look this as a business model for not less than 5 years and reap the benefits.
Absolutely,
So
very well said. In fact, that's what we have been always endorsing to a lot of people coming into the equity market, saying that you should at least look at it from a 5 year horizon. You cannot just say, look, I have about a couple of lakhs surplus. Can I put it for the next 12 months or 1 year and make some gains out of it? We don't know. I mean, none of us know what exactly will happen in the next 12 months. We may be in the most wrong of times to be investing in it. I mean, somebody who came in late 20, mid 2024 has really not. I mean, if you just look at the 1 year comparison of Nifty since the last, exactly 1 year from in 2024 August till the date, I mean, we're hardly gained 2 to 3%. I mean, it's not great return. So I think that's where if you give yourself 5 years, the the compounding factor will really kick into place, and that's when, like you said, 15 to 18% sort of returns from a direct equity investment should be good.
If you allow me, I would also like to give some of the examples with my own clients. I mean, obviously, it is too human that when the money that has been invested slashes down by 30-40%. Last year, a lot of my clients have got panicked, and then I've been always constantly coaching them like, hold on. When the market recovers, these are the sectors, these are the stocks which are going to give you multiple gains. These are the stocks where you will stand to gain. So now we are seeing some sort of a rebounds in those stocks. So now all my clients, like, they are understanding that yes, patience is the key in the stock market. Yes, I'm not saying not every stock or not every business model you choose will stand to gain, but if
Correct.
50% or 30% will stand to outperform, 30-40% will perform as per your expectations, and remaining will not even perform. So I would say that your portfolio is well balanced and well insulated in that.
Absolutely, absolutely. I mean, when you talked about NBFC, I just recollected, not going into a stock specific discussion here. Uh, because I have these technical scanners, I keep running once in a week, and just late last evening, after the data was collected by the software, I just ran for stocks on a weekly time frame, which are kind of either at lifetime highs or a 52 weeks high or breaking out. And you had some of these big NBFC names coming there, and the first thing we will naturally say is, look, it's at a 52-week high, it's at a lifetime high, there'll be a selling. Let me wait for a couple of percentage dip. Let me get back into it. But the kind of volume buildup I'm seeing in them, I don't think if you wait, you're going to have any sort of pullback or dip for you to buy in. I mean, they just can rage through the
Right.
resistances, and by the time it might already be 20-30% up from there. So NBFC is one sector I completely agree with you. I too am positively looking for a couple of large companies breaking out from a 52-week high, or almost, I would say, an 8-year sort of consolidation. So technical analysts or enthusiasts would agree what a breakout from an 8-year consolidation would turn into a price action. So very keenly tracking some of these stocks, and hopefully, if things are in order, we are planning an episode with on particular sector discussion, which would kind of help investors choose the right stocks in the right sectors in their long-term investing. Now, coming back to my part of the information, US markets, like you rightly said, continue to rally. Not much inputs on that side. Nifty, which did start off positive for this week. See, I've been telling that 25,000 is a major, major, major resistance. We did have a ray of hope that 25,000 kind of was breached. Eventually, markets gave up. We saw what happened on Friday. I think it's most ideal that I share the screen to our viewers to. So, I mean, all those people, all those traders who are tracking technical analysis would know that we have a breakout, we had a good support. It was a good positive opening for the week, a good gap up, but the point that we closed negative than the opening for the week is a little bit of a setback, but yet we are kind of poised above both the moving averages, which gives a positive sign. But what I'm really concerned about is the 25,000 call option, this big mountain that you see, which says 25,000 is a big, big, big landmark, and not just a milestone, but a big landmark to be breached. And only after we breach that is wherein we can think about positive signs in the market. But yet, at every stage or every 200 points of Nifty, you see major resistances coming in the form of call option selling. On the downside, the mountains are not too high, which means that the downside is still open. It is not just a neutral zone, but 25,000, while acting as a major resistance, can also push the prices lower, which kind of gets signaled if these prices start coming below moving average, we might have a downtick. So at this point in time, for the next 1 week, I would want a positive close for the week with the candles closing above both the moving averages, and as much close as possible to 25,000. And I see the open interest of call option selling coming down. Only then I would like to go long on the Nifty. Otherwise, I would I don't mind still staying away from Nifty, from going longs on Nifty. The main big boy has been Bank Nifty has also been kind of negative for the week. So again, all those technical analysts would understand that overall we are in the positive trend on a weekly chart, but yet we have tried to fall back to the neutral zone wherein the prices are trading between two moving averages. So it's kind of a neutral zone. So not much view can be given. So no new initiation of position at this particular week unless we have a major uptick in the next 1 week. I'm not looking to build any long positions either in Bank Nifty or Nifty. So, having said this, I have one question to ask to Prabhanjan. Uh, how worried are you about all these, bubbles or the recession talks of recession? I know recession talks has been around for a very, very long time, and now the market has replaced it with bubble, which was initially predicted for 2025. Now it's 2026, and they say it's going to start with the tech bubble in the US, and the Indian markets are going to be affected. Uh, we spoke about it a couple of weeks back how the macro and micro are not completely well. It's like a push and pull scenario, but the money flow into the Indian markets is so high that there are not much redemption requests, and the money flow is there. The fund managers are, flush with cash to deploy into the stocks or the sectors that they want to. But from an investment point of view, Prabhanjan, on the ground level, like I said, somebody who has come in 2024 or mid 2024 has not really seen great returns. At some point in time, and most of them would have come into the markets thinking that the kind of returns they saw on the newspaper or on the friends or their family or their peers would have achieved. I too want to achieve it. They would have come in. And the first 1 year would have probably made them second guess their investments or even make them a little restless. And any investor, as a matter of fact, at the end of the day, we are all human beings driven by emotions, which is there is nothing wrong about it. At some point in time, we would want to see money growing, and so far, the last 1 year, it has not. And do you think if the trend continues, I need not, I'm not saying that the market have to fall by 8 to 10%, but even if the market stays quite range bound for the next 2 to 3 quarters, do you still feel the investors are going to be confident about the markets? Or if somebody is second guessing the markets, what would your advice to them be?
Right. So, I will answer this question a little differently. Let me share my own story. I don't know whether I can call it as a success story or not.
Okay.
Let me share that. This will exactly resonate what you say, and the stock market enthusiasts will find out answers by this well. You know, I have started, investing in the stock market from 2008 onwards. I mean,
Oh,
2007, and that is where I have seen a big stock market crash in
the
2008
Lehman Brothers collapse.
and the collapse. I was saying every day in the moneycontrol.com, at that time we never had any big capital. Even 10,000, 20,000 is a big one. So 100 rupees, you lose it, it will create a panic. It used to create a panic in my, brain. So I always every day I used to check, अरे क्या हो रहा है अरे आज तो 100 रुपए गिर गया कल तो I mean every day is like 1%, 2%, it makes a difference. Then what I did was, okay, if it is going like this, so I 2013 I have seen the same thing. I mean, it's another big market crash. So in 2008, whatever I have invested, I lost about 30-40%. But I didn't sell it. I just kept on holding it. But when it came to 2013, the whatever I have invested, it has not grown at all. But I still further lost it. So
Hmm?
that was a call when I have taken in 2014 that enough. Let me just book all the losses and start things afresh.
Okay.
So I booked all the losses, and then I started. I never lost a confidence in the market, but I by in 5 years you would also be earning a little more. So I put some more capital, and then I started investing in a more methodical way. That means
Right.
you will be a lot of you will gain also a lot of experiences. So when you gain a lot, you will never get an experience, but when you lose a lot, you will get a lot of experience in the stock market. So that's where I started understanding. I started getting a lot of experience from 2008 2013. Then came 2021. That is where my learning has improved. That means I have I've been watching the markets, and then when the things came up. Luckily, I was sitting on cash. You know, almost 80% I was sitting on cash before the COVID hit. When
Wow.
that time, I when the market crashed, that was the time I never lost confidence because I have already seen two cycles. So
Correct.
that is where I started my investing aggressively, and then COVID is the period where the markets was crashing. I mean, maybe I was one of those persons who was shopping on the stocks. It is like 2013 where you even like a name a poll like Mr. Modi, and then you put it in a polling booth, it will win, something like that. So during the crash, you pick any stock,
Anything and
so
everything moved up.
moved up. So there was no much of a mind that was applied, So and I have applied one strategy there. I have to improve my capital. So I can't stick and then remain for so long, right? Right. So since being a chartered accountant, I started doing a capital turning. I mean, capital turnover ratio. I started increasing it. So whatever I had, if I get a 5 or 6% gain on my entire portfolio of the stocks, I sell all the stocks and then again reinvest. So that way, 10 cycles, 12 cycles, I did it, and that improved the amount of capital what I have
Capital
gained.
as well.
So these are all the learnings from what I have done. So now to answer your question, um, do I still? It makes me more panic when the market falls. Absolutely not. It makes me more because we have. I'm not saying we have understood everything, but fairly we know how the market goes. And there is a saying: market has only one direction in the long term. That's only upwards. And when we are long-term investors, we are only going upwards, provided
Correct.
follow the fundamentals of investing, management quality, stock quality, earnings upgradation. I mean, provided all these things are taken care of, then the stock market only moves up. It's only the patience. So these three cycles have taught me the patience. I would always urge investors: number one, to have patience. Invest in right stocks. Pick an expert. Don't do it yourself approach. That is not going to yield results. I mean, play by your strengths. Play by your forte. If investing is not your forte, go to an expert. So, I mean, and have a long term vision. So that's where I always advise my investors.
Prabhanjan, I think we had, there was a poor connection in between. So, I mean, what I understand of all this is you've already given us a good 5 to 6 sectors, and you have the best stocks from each sector, and you will still have about good 14 to 15 stocks for the long run. And one point to add here is, compared to 2013 to about 2019, when there was series of, you had the Brexits, you had the, demonetizations, you had the COVID, so many frequent, international factors influencing the markets. Now we are in this decade, we are much more insulated. We are as strong as the domestic inflows are very very high. I think we are much better placed than we were the last decade. So all those people who have seen 2 decades of market rally, market who have been in the market for 2 decades would understand the kind of golden throne that we are sitting in right now. Having said that, we need to be patient and understand that markets are cyclical in nature, and only the best and the most deserving stocks perform. And it's the duty of the investor as well as the investment advisor to identify such stocks. And we are always there to bring in more weekly outlooks and information to the viewers to have them better placed to make these sound investment decisions. Just a quick disclaimer: none of the discussions that we make here constitute any sort of advice or advice or any inputs towards a stock or or any sort of investments. So please do consult your financial advisor and understand your risk tolerance, personal risk tolerance, before making any investment decisions. Having said that, we continue to believe that the markets are going to keep us on tight ropes for the next couple of quarters, considering that there are so many international factors as well as domestic factors that are influencing the markets. And we will continue to be in touch with you through our online sessions to help you understand, make the best investment decisions possible. So until then, please do subscribe, like our videos, and stay tuned. We'll catch up with you once again next week. Thank you, Prabhajan. I'll see you next week.
Thank you, Ashwin. Thank you so much.
Baby, I'll show you.